Good morning and welcome everyone to the Moneycontrol live stream. You are watching Markets with Santo and CJ. Well, the mood of the market keeps on getting worse, it seems, Santo. I mean, the mood swings that we are seeing, probably I even don't have that many mood swings the way the market has these days.
Clearly, I think very nervous market right now, given that every single fundamental factor seems to be against it at this point.
Well, but at least today's mood swing is on the good side, because if you look at the Nifty futures on the Singapore exchange, they're indicating a gap up opening of possibly more than 150 points on the Nifty. This is despite the fact that US markets actually continued the sell-off that they have been seeing throughout this week. They ended on a weaker note. But the Asian markets are the one who have picked up the baton and have seen a very positive start earlier today. So we are probably following the Asian cues today. We have decided that Asia is the market we want to focus on and not the US.
Well, as for the Nifty SGX, already it was up even higher this morning, and I think it's given up some of the gains. And I wouldn't be too convinced, even if there's a rally today, I wouldn't be too excited. This is clearly a sell on rise rally, CJ, as I see it. The overall mood still continues to remain very negative, and the feel I get speaking to brokers and dealers at broking houses is that retail money, retail participation clearly is on the ebb. HNIs were bottom fishing till about last week. Now that's also, given the sustained fall in share prices, they are also a bit worried now. And just look at the FII numbers, again close to 5,000 crores of selling yesterday. Remember, liquidity is going to be a big problem in the days ahead, with the Fed also tightening its balance sheet. It's already raising rates. Besides that, you also have the Fed tightening its balance sheet. Given the liquidity situation, I think even if you see some softening in crude oil prices and valuations becoming attractive, I think clearly bulls are on the back foot for now.
Well, if you just look at FIS selling in isolation, Santo, it feels like we are edging closer to the doomsday, right? It seems like there's judgment day upon us and we have to sell everything and just probably search for a new planet.
Apocalypse.
But, yeah, exactly. It's very apocalyptic if you look at the way FIs have been selling. And even now, it seems, as you mentioned, the retail investors also have started to take back a lot of their long positions in the market. So at least, and you have to remember, even if we see a gap up movement today is a Friday, right? And over the past 7 to 8 weeks, Friday trade has been one thing that people have been watching out for, and we will have to see whether this strength in the market probably at the open will sustain towards the end of the day. That said, let's now quickly dive into some of the stock actions that could be very much buzzing in the trade today.
Well, starting with Dr. Reddy's, the pharma company announced its fourth quarter numbers yesterday, in line with what most analysts were expecting. Now, Morgan Stanley is positive on Dr. Reddy's. It is said that the company's there's been steady growth across all of the company's businesses, and besides, the company continues to invest heavily in biosimilars, complex generics, and new chemical entities. So these should to some extent help offset the weakness that is being right now seen in the US generic market.
Santo, if you look at just the profit number yesterday, there was a deep cut in the profit year-on-year basis, although that was largely because of the impairments that the company took in the March quarter on certain assets of the company. That said, my concern largely is that the price erosion in the US that a lot of companies talked about last year, it's still a major concern for companies. Even though Dr. Reddy's did have around 14 to 15% year-on-year growth in the North America market, I feel that probably Street is probably still underestimating the level of price erosion that one might see, given if you go by the commentary that Alchem Laboratories gave recently. Apart from that, there is too much. If you look at what Credit Suisse has to say, they believe that there is too much optimism from one particular drug of Dr. Reddy's, and that is the Revlimid generic. Now that generic is a specialty drug, so therefore generally you will expect good margins on that sort of a drug as and when it comes out in the US market. But there is possibility that given the pricing environment in the US, the benefits may not be as great as a lot of investors and the market has been pricing in. So for me, Dr. Reddy's I will still be a fence sitter on Dr. Reddy's. I am not still convinced that the revenue growth that the company had seen probably over the past 2 years, also aided by the domestic business, will sustain, and plus margins would be the major factor here. yes, for a lot of other companies, margins have been an issue, but maybe not so much for pharma. But going ahead, given the pricing environment in the US and given these companies' high dependence on US earnings, margins could be something to watch out for.
Well, CJ, this thing about price erosion has been, it's not something new. There's been the concern for more than 5 years now.
True.
Right? But from 2017 onwards, if you look at the revenue top line trajectory of Dr. Reddy's, about 14,000 crores of sales in FY17, and now in FY22 it's about 21,000 crores. Okay, there's a 50% rise. So clearly, despite the pricing pressure, they have managed to grow its top line. Yes, earnings have been under, they've pretty much been range bound. There's also reason for that, pharma companies generally have to invest quite heavily in research and other things. So to some extent, the pressure on earnings is natural. As for Revlimid, it's a huge market. It's almost a $8 billion drug. In the first 6 months itself, Bristol Myers Squibb did about close to I think $5.8 billion. Also remember, the settlement it has reached with both Dr. Reddy's and Nalco is for a limited volume amount. So it's not as if the market will be flooded with this generic. Also in the first year, the price erosion, as most analysts see it, because of this volume limited factor in the agreement, the price erosion won't be all that great. So $8 billion is the market that we are talking about. Even a small size of that should be good enough.
Well, there is also a risk of Dr. Reddy's still facing litigation issues from some of the payers in the Revlimid market. So therefore, I would not say that it's totally given that Dr. Reddy's
it's not given, but look at the price. A lot of concerns are already priced in. From the peak of 5,500 odd, stock has already fallen.
Yeah, that is true. The stock has corrected, but that does not mean that it does not mean that it will
litigation is a fact of life in the pharma industry.
Anyway, one stock that probably will see a lot of action today in trade is Eros International. The company yesterday came out with a disclosure wherein they have said that they are going to issue warrants to their promoter as well as few other investors at a premium of about 22%. If you look at the number of issues, number of warrants that they are issuing is about 13.5 crore warrants that they are issuing at a price of about 30 rupees per share. And the new capital that the company is going to get, about a little more than 400 crores of capital that they are going to get because of this warrant issue, is largely, I believe, going to be put into their movie production and other digital businesses, which probably will now see a lot of bandwidth, given that theaters have reopened and there is a renewed push from producers to get in more movies into the pipeline. So therefore, things are looking up for Eros, given the sort of underperformance that the stock has seen over the past 4 to 5 years.
Well, to me, okay, so because of this, the warrants being raised at a premium to current market price, you might see a temporary blip in the stock price, a temporary surge, but I would be very wary of the stocks. There's been a complete wealth destroyer for almost 10 years now. It peaked out at about 629 6 years back, and since then it's just been going downhill. If you had bought the stock at any point over the last 5 or 7 years, you'd still be sitting on huge losses. Well, that apart, if you look at the top line growth, it had already been slowing even pre-pandemic. Of course, the last 2 years were particularly bad for all media entertainment firms. But in this case, the sales had been steadily falling even otherwise. Company is deep in losses at this point. It might turn around. Probably you could see a temporary surge, but this is not something I would want to keep for, let's say, more than 6 months.
Santo, even if I take your concerns into account, all I want to do is just time this right? Even if I time it right, I can make in excess of 20% returns. So
there
that
you go, momentum. Tata Steel, the third stock on our watch list today. Now, steel stocks in general, metal stocks overall have been taking quite a beating over the last couple of weeks.
Yesterday they were among the worst
performers. Now,
basically.
in the case of Tata Steel also, the stock has been under pressure over the last couple of weeks. Now, things could only get worse from here on, because there's been some softening in steel prices over the last month or so. According to a report by Motilal Oswal, the demand in April has been lower than what was seen for domestic steel, has been lower than what was seen in February and March. And then there are seasonal factors also at play. As we are nearing the monsoons, typically construction activity slows down a bit, and that could result in lower demand for steel. Besides, CJ, I'm also worried about this whole reopening of the Chinese economy, which means that probably you could see higher steel imports, steel exports from that country.
I really doubt that is going to be the case, Santo, because China has already placed limits on the amount of exports it can do. I don't think they are going to come out with such booming exports that it takes down the entire steel market and steel prices going forward. In fact, China's revival, the revival in the Chinese economy going forward as the lockdowns ease, it would be among the major triggers for steel prices across the world and also for steel exports. Now, if you look at the iron ore futures, which is a very important ingredient used in steel and usually determines how steel prices also move, iron ore futures have risen about 5% the past week, right? In the week in which we have seen lockdown news of lockdown restrictions easing in Shanghai coming out, you have seen stainless steel futures also rise about 3 to 5% this same week. Now that goes to show that possibly come May, come June, come July, we will see steel prices again moving higher. And for me, the important part is that the export side of the business for a lot of the steel makers in India will now start showing much more better momentum. Why? Because over the past 2 years, it was never the domestic market that was driving the volumes or the growth in revenues. It was the pricing power that they had exhibited as well as the strong export growth that the companies had seen. Now with China probably boosting its construction sector in particular to probably meet its GDP target, I feel that exports again will be the lead in terms of volume revival, whereas the domestic market, of course, the pace will slow down, as you mentioned, because of construction going on a halt due to the monsoon. So for me, the story still remains quite intact. Yes, April was a muted month in terms of steel prices. February, March were a little volatile. But I will still not give up on Tata Steel yet. Given the sort of correction that we have seen in the metal space, this could probably be a good time to staggeredly enter into some of these big names in the steel space.
See, if you look at the Tata Steel chart, it's still 26% of its all-time high.
That is why I'm saying that it is possibly a good point of entry.
And it's getting support around 1,000 rupees. It's not broken that level, but at the same time, there's a stock that's not been going anywhere for a while now. That's something that traders looking to play.
That is largely because of the concerns around the domestic pricing. But I feel as and when you will start seeing data pick up in China, that sentiment will also turn around, and it doesn't take a long time for investor sentiment in the steel space to change, right? We have seen that over the past 6 months itself, how sentiment was bullish when the Russia invasion happened in Ukraine, and then out of the blue it turned negative from mid-April onwards. So this is something that could turn around very quickly. All that you need to do is just time it right? Talking about timing, Ashok Leyland, well, we know what ITC has done this year, right? It has been one of the standout stories, and it's been one of the hiding spaces. I feel Ashok Leyland could be a good candidate for investors to hide in this year. If you look at the Q4 numbers, the numbers were pretty strong, way above the street's estimate, and they are just adding to the confidence in the stock. The company actually ended up winning market share in the trucking segment or the truck segment in Q4, which goes that there is demand revival happening and there is some sort of pricing power that the company is exhibiting, even though it ended up passing on some of the input cost increase during the quarter. And overall, if you look at the CV space, if you speak to a lot of CV financiers, Santo, who have also recently declared their earnings, this is one space that they're actually very bullish on. Apart from microfinance lending, CV lending is one space that is really picking up. That goes to show that there is demand on the ground for commercial vehicles, and naturally so. We are seeing the economy pick up. We are seeing the economy open up. E-commerce has of course been a big driver. So I feel Ashok Leyland could be one of the ITCs in this market to hide in.
Well, CJ, fair point,
Santo, before you blast me with your rebuttal, let's see how the market has opened. And it has been a very strong start. Nifty is up about 1.3%, while Nifty Bank is leading about 1.2% at this point of time.
Well, quite good market breadth there. About 1,718 stocks are trading higher compared to about 139 stocks that's down.
And Nifty Midcap is doing quite well. Nifty Midcap index is up about 1.7% in trade right now.
JSW Steel, Hindalco, Tata Steel among the big
gainers. Tata Steel also higher by 3%, Santo.
Well, these are the stocks that took a big beating yesterday, so some kind of bounce back was inevitable. But the near-term story, I think CJ, it's still I would be bearish on the metal space.
I think there is a saying in football, you know, if you listen to a lot of football managers, they always say that you have to go day by day, match by match, right? And I think even in this market, you have to probably go day by day and take what comes your way. And at this point of time, of course, the shorts have been trapped from yesterday, because remember yesterday, even after 2:30, we saw a selling momentum actually catch up, which indicates that probably a lot of shorts were built into the system. And it is possible that this sort of a gap up opening might be able to sustain, but we have to wait and see what happens at 2:30 when the foreigners come and just dump a bagload of shares in the market.
I wouldn't really bet on the market today holding gains still close. But that said, the point about Ashok Leyland, you know, good improvement in the company's financials.
Absolutely.
Besides, I take your point about the recovery in the CV space, but yet at the same time, it's very surprising. Look at the stock chart over the last 6 years, 7 years. Stock again hasn't gone anywhere.
Yeah, because
really.
the CV story was dead for the past 4 or 5 years.
But in comparison, you saw all the other auto stocks doing well. So this is Ashok Leyland clearly has been one of the biggest laggards among in the auto space. It has given some good trading opportunities though. There are sharp falls. It becomes very undervalued, like during the pandemic it was, and then it bounces, and then again it kinds to stagnate.
Santo, I'm an opportunist. So trading opportunities is all that I'm looking for in this sort of a market.
This seems to be a stock where the market doesn't appear to be willing to give a certain valuation premium as when you look at it compared to other auto stocks.
Valuation premium has been hard to come by for Ashok Leyland because of the cyclical nature of the business, right? CVs are very, very, unlike say passenger cars or maybe even two-wheelers, CV is a very, very cyclical business, given that it's very closely linked to how the economy behaves. And we know for the past 4 years, even before the pandemic, the state of the economy was not really that great for good amount of manufacturing activity, industrial activity. So now that there is belief that capex is picking up, manufacturing is picking up, also aided by the PLI schemes that the government has brought out. CV is one space that could be a proxy to all that story, right? We have seen capital goods being said as a proxy to the capex story. CV could be the proxy to the overall, economic story. And you have had the finance minister come out and say that she expects robust growth this year, more than 8% growth in GDP this year, which is actually quite optimistic compared to the other estimates you see even from IMF and the RBI.
Well, the last stock on our watch list is Star Cements. Very tepid set of fourth quarter numbers. The company is facing severe margin headwinds, and while smaller cement companies have been in the limelight over the last week or so following the Adani Group's decision to acquire a wholesome stake in ACC and Ambuja Cements, but this is one story I think would take some time to play out. Margin pressure is likely to sustain for some more time. The earnings again has not really gone anywhere over the past many quarters now. So I would be bearish on Star Cement.
Santo, I don't think you should be as bearish as you are reading the March quarter numbers. Yes, the margin pressure was there. Yes, net profit growth was very, very muted, less than 5% almost. But if you look at the volume that the company came out, more than 20% growth in volumes, more than 20% growth in revenues on a year-on-year basis. That goes to show that there is at least demand on the ground, especially in the regions that Star Cement is very prominent, that is the Northeast and the Eastern India region. As far as margins are concerned, I feel that the management has indicated that they are working towards managing their costs better. The cost optimization is happening. They have also indicated that they have undertaken price hikes in April and possibly in May as well, especially in the Eastern India market. So maybe that margin concern that is there might reverse a little bit in the June quarter and the September quarter going forward. But the key thing here is that the Eastern India market remains a high growth market. Why? Because it's largely underpenetrated, it's largely underdeveloped. The government itself has been focusing a lot on the Eastern India space in terms of infrastructure developments, especially if you look at the border states and those sort of area. So the volume growth is there. Overall, the guidance of the company also was pretty strong. They're expecting 17% growth in volumes in FY23. So with all of that, taking all of that into account, I think, and taking into account the cheap valuations of the company compared to its sector peers, Star Cement could actually be a good turnaround story to bet on.
Well, And on that note, we move on to the sectorology segment.
Yeah, and today we have sectorology today, and on sectorology we'll be focusing on the FMCG sector because a big news came out yesterday. The fact is that, Santo, last month when Indonesia decided to ban its crude palm oil exports, given that it is one of the largest countries out there who export the product, it created a lot of negativity for FMCG stocks. We have seen how FMCG stocks had reacted. Most of them had corrected to 3 to 5% on the day when the ban was announced. And the natural fear was that if this continues, then crude palm oil prices will shoot up. And given it is a very, very key raw material for a lot of the FMCG companies in India, it will further dampen the margin issue or worsen the margin pressure that the companies have been facing. But now, yesterday, reports came out that Indonesia may reverse its ban come May 23rd. So it seems like it was a very, very short-lived ban to possibly control the domestic prices, that high prices that Indonesia has been facing. Apart from that, if you look at some of the key metrics, benefits out of this reversal and ban, the global prices might see some correction. They had shot up quite a lot in the period after the ban, but now you could see some moderation happening in the crude palm oil prices internationally. And at least from this side of the story, FMCG companies can now breathe a sigh of relief that at least this issue that was hanging over their heads, although I am not so sure how much of the impact they felt given the short nature or short period of the ban, but at least going ahead they will have clarity that this is not going to affect their margin strategy going ahead. But that said, I'm sure you have points to rebuttal and how this is not something that I should be really happy about and I should be more cautious.
Well, CJ, short term we could see a bump up in FMCG prices.
I'm expecting a relief rally today.
Purely sentiment driven, but couple of things here. Now, when Indonesia is saying that it will go back on the ban, one again needs to be a little cautious there, because when it had announced the ban, initially there was, before it formally announced the ban, it had said that it would not be a across the board ban,
okay,
crude would be spared and all that. But then it did a complete about take and it then ended up banning every single thing. Now, as you mentioned, the impact was not felt by FMCG companies, because the ban period itself was very short-lived. They have reversed it very quickly. I mean, they have not reversed it yet, but they've said that they would reverse, but I'd still wait for that. But the market already seemed to have, some inkling of this. If you look at the palm oil prices in global market, they had started coming off a bit.
Yeah.
And the story is not entirely about palm oil. Palm oil is one part of the story. Yes, it is a key input for many of the FMCG companies, but you have the bigger problems which have been around for some time. That's inflation, which is eroding demand and also hurting the margins of FMCG companies. So yes, you will get some relief as far as palm oil is concerned, but the longer term picture, for FMCG right now, given that margins are under pressure and also valuations are still expensive, so I don't see the stocks going anywhere in a hurry.
Wow, it's so weird to see you being so cautious on a defensive bet in a market like this, Santo. I'm sure that you're going to tell me, oh, valuations are still expensive, this is no defensive.
Well, see, good investing is also about not doing anything for long periods of time. If you go through Twitter regularly, that's what the experts will always advise you. Good investing is all about that.
What happened to Warren Buffett quotes and Warren Buffett gyan?
You're seeing
I thought
more
good
of them.
Investing was all about buying today and then forgetting it for the next 10 years.
If you look at Warren Buffett, he doesn't buy, every now and then, right? He waits for the opportunity.
Even
and
Warren
then makes
Buffett is a momentum investor, no?
Everyone
yeah,
is.
with that, of course, it's time to take your leave. Thank you so much for joining in, and we will catch you live again at 3 p.m. In the meantime, do post your feedback at the comment section below and follow us on the social media links at the bottom of your screen.
Thank you for watching and have a nice day ahead. Happy trading.